So you have a home improvement project and you need some additional funds. Should you take a home equity line of credit or a HELOC, or should you take a loan against the equity of your home or a home equity loan? We're gonna go through some of the advantages and disadvantages of each of them, and then at the end, I'll tell you which one I would typically recommend. Okay, first let's start with a home equity line of credit or a HELOC. This allows you to take a line of credit, a revolving line of credit from the equity of your home. You typically need to have a certain amount of equity within the house to be able to start taking money from it, but it does provide a little bit more flexibility than some of the alternatives. So HELOCs provide for funds as needed. So if you've got a home project that is on the horizon, you're doing an addition onto the house, and you need some additional funds, you can actually apply for a home equity line of credit at any time. And I typically recommend that people, once they close on the house, as soon as you've amassed about 20% equity in the house, to take out a HELOC right away. It doesn't affect credit. It doesn't mean you've got to start making payments. You just open up the line of credit, which now gives you the ability to take funds as needed. So if there's an emergency, you'll be able to tap into it. And then of course, if you've got an addition on the house or a renovation within the house, you'll be able to access funds as well. So it provides a little bit more flexibility because it's a use it when you need it. So if you have some plans for the home where projects are spread out over time and you don't need all of the funds right away, a HELOC can make a lot of sense because you can draw the money as needed. So for example, if you were to take a $50,000 HELOC from the equity of your home, but right now you only need $15,000 to get started. Maybe you've got to pay an architect to draw up the blueprints of the plan. You can use just 15 out of the $50,000. And then you can go in and draw 10,000 and you can start to pay that back. And then you can go in and draw 6,000 and start to pay that back. You're not subjected to start repaying on this until you start taking money out. Another benefit of a HELOC is that it provides some flexibility with the repayments. So you can actually set this up so that you are interest-only repayments to begin with. You do that for typically 5 years, 3, 5, or 10 years, where the repayments on the HELOC are interest only. So the repayments are lower now, and then when that time is matured, then you start paying back interest and principal, and of course the payments at that point would be higher. But this provides a little bit more flexibility where if funds are a little bit tight right now, but you think cash flow might be a little bit better in the future, then you could just subject yourself to a lower payment with interest only, knowing that the interest is variable. Okay, so depending on wherever interest rates are going, that's where the interest on the HELOC will go. At least provides you some flexibility to just pay back the interest and wait to pay back the principal and interest at a later date. So let's expand a little bit on the variable interest rate. So for years, variable interest rates for HELOCs were a little bit scary. We were at historically low interest rates. And we knew that interest rates were going to increase at some point. Now that we know that interest rates are starting to come down a little bit, variable interest rates with HELOCs aren't so scary because they may go down. Doesn't mean they won't go back up before you pay it off. But chances are, if you start taking out these HELOCs now, this is 2024, interest rates are starting to decline a little bit. So it actually might work out in your favor. Okay, let's discuss now tax benefits. So the interest that you're paying back on the HELOC may be tax deductible to you as long as those funds are used for home improvements. So you can't take a HELOC and then go take a trip over to Hawaii and then write off the interest on the loan repayment. The interest on the loan has to be used specifically for home improvements for you to be able to deduct that. And you also need to itemize your taxes. So if you're taking a standard deduction, you're not able to do that. But if you're itemizing your deductions on your taxes and the money is used for home improvement, then you'll be able to deduct the interest payments. Okay, now let's talk about home equity loans. So this is another form of loan that you can take from the equity of your house. A home equity loan provides a lump sum payment when you apply for the loan. It's typically approved by an underwriter in a bank or whatever institution you choose to take the loan from. And then your repayment would start as soon as the lump sum is received by you. And that repayment plan can vary from 5 years to 10 years, 20, and you can amortize it to 30 years as well. Most home equity loan repayments are typically paid off early, meaning that clients just decide that, hey, you know what, I'm just going to pay this off. I had a good year. I'll pay off it in chunks. I'll pay this loan off in chunks. But you can extend the loan payment, typically, depending on the bank, for up to 30 years. You have a little bit less flexibility with a home equity loan because it does provide a lump sum. So if you plan to do a home addition or renovation in 6 months and you apply for the loan now, and you've received the loan payment before you actually need the money, you've got to start making loan repayments before the money's actually spent. Similar tax benefits as a HELOC. Interest is tax deductible as long as it's used for home improvements. And some people just like the simplicity of home equity loans. It's pretty easy. Yeah, for example, if you needed, again, a $50,000 loan, and you get approved through underwriting, you receive the $50,000, and then you start paying that back for whatever period of time you set that up with the bank. And for some people, it's just easier. I get the money, I pay it back. Here's which one I like more. I like HELOCs more than home equity loans. They provide greater flexibility. You can pull the money out when you need it. You can establish the line of credit as soon as you close on the house or soon after. And you're not subjected to have to pay a certain amount back before the funds are actually used. Both are totally reasonable options for those who are adding to their home. And now, given in the environment that we're in right now, where buying a new home is so incredibly difficult for a lot of people and mortgage rates are high, a lot of people are making the decision to stay where they're at and just doing an addition to the home. And tapping into cash or tapping into 401ks or other retirement accounts is just not a viable strategy. A home equity loan or HELOC may be a great strategy, and a HELOC, I think, for most people provides a little bit more flexibility.